Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news without the children. They can be a bit confusing, misleading, and take us off course now to make it actionable, understandable, and clear. Alas, there's no snow, and therefore there are no children. We must trudge forward with just me and the dachshund, who won't be on the show. Excellent show, excellent week of news. The CFPB, which I bet you don't know what that stands for. I really didn't either. The Consumer Financial Protection Bureau is suing Capital One. This one hits close to home for me, and we'll talk about why sound advice is so important. We then will look at excellent data by Mr. Mark Meredith on the X platform, detailing just how far down the rabbit hole of chasing returns we can go. Because boy, has it been a good decade for returns. And we'll look, he looks at the last 13 years. We then also look into a fascinating data set put out by Mr. Peter Mallouk of Creative Planning about the drawdown in any given year. It's fascinating, meaning what is the maximum drawdown, top to bottom, in a year that occurred versus what was the actual return for that year. This data was such a great encouragement and shocking. And then we end with a fascinating Wall Street Journal article by Mr. Ben Foldy about one of the great short sellers calling it quits, Mr. Nate Anderson, and what he's doing. But at the top, a CNBC article by Russell Leung, CFPB, again, Consumer Financial Protection Bureau, sues Capital One. What's in your wallet, they say, for cheating customers out of over $2 billion in interest. Subheadline, the Consumer Financial Protection Bureau announced it was suing Capital One for cheating customers. The agency said the banking giant used deceptive marketing to obscure differences in interest rates between two of its savings account options. Capital One denied the allegation and said it widely advertised its high-yield savings account. Now, I mentioned on the intro this hits close to home because it did. Hit very close to home. So Capital One is where I have a checking account and a savings account. And 2 credit cards. This is a little bit of Robert's Corner earlier. I use Capital One Quicksilver, 1.5% cash back, no fee, no foreign exchange fees. Bada. I use one credit card for the utilities, the other one for shopping wherever, because I got tired of getting hacked. This was a devious move by Capital One that I almost fell for. So what they did, and I'm going to give you my version of events, and then we'll let you be the jury. I had a Capital One savings account. They opened up a new type of Capital One savings account and lowered the yield on the existing savings account. So I was just bumping along, and so was everybody else in the country, with some sort of a 360 Capital One Performance 360 savings account. You see how close those names are. Not realizing, whoops, these two had really different interest rates. And to the consumer, to me, and to clients, and I eventually started catching this with clients because I caught it myself. Capital One had a 360 savings rate at 0.3% and 360 performance savings at 4.35%. The 360 savings was advertised as a high interest account, according to CFPB, and it was. Here we go. The Bureau said the Capital One aimed to keep 360 savings users in the dark about the higher yield option by replacing all references to the account with a similar name 360 performance saving option on its website. That is the truth. That is the truth. This is someone I like, Capital One. I think they're just a great company, and they totally messed up here, but I still use them and like them. This to me was devious. Sneaky. They had all these accounts. They lowered the interest rates. They opened up a new account with a higher interest rate, and they dropped all the verbiage from the old account. So if you had this old legacy account, you just assumed you got the higher rate. It wasn't until you clicked in and you realized, huh. Now the bank says, here we go. The 360 performance saving product was marketed widely, including on national television, with the simplest and most transparent terms in the industry. Here is why you might need an hourly financial advisor. We live in a world this side of the Garden of Eden where institutions and individuals, this is a company that's telling us to our face, guess they call this gaslighting. Oh no, we told you this new product was out. We told you this was better for you. Well, you and I both know Capital One could have simply just adjusted the interest rate and had all their 360 savings products be the same interest rate. But why didn't they? Because it benefits their, they call it net interest margin, the rate which they pay depositors and the rate which they charge borrowers. If you can not offer a lot of interest on your deposits, you're going to be a more profitable business. And so I just don't believe it. This is out and out. I see this as a bold-faced lie. The legal department. I think if Capital One had any courage with marketing, they'd say, we messed up. We totally messed up. You're right. Here's the interest in arrears that clients would have earned. We totally dropped the ball here. We had short-term thinking. But what's going on with Capital One right here, this little moving the ball, hiding the ball, it happens all the time in financial services. And so you've got to be wise as a serpent, innocent as a dove when you engage with any financial services house. It doesn't matter if it's Charles Schwab, Fidelity, Vanguard. It doesn't matter. I've experienced gotchas in every platform so far. And you don't know when you'll get it. So you have to be on it. I'd say this is especially if you have a financial advisor. Having a financial advisor doesn't get you off the hook. It helps if you have an hourly one. At least that means they are being compensated in a transparent manner. But the lesson here is not that Capital One is worse than any other. I still use Capital One, and I will continue to use Capital One. I think they got great technology. They've got good people to work over there. The point here is, if Capital One's doing this, and in my view, they're best of breed, you can only imagine what other folks are doing. It's a bad, bad deal. No one cares more about your money than you do. We cannot go hat in hand to these institutions and just presume that the legacy of John Bogle will permeate forevermore at Vanguard. It's not. They're cross-selling at Vanguard. Or that at Fidelity, you'll receive a fair shake. Hardly. I've been on me, the client, and Fidelity, and I'm listening in as Fidelity is trying to sell absolute garbage to a widow. It'll make your blood boil, and then smile in your face as they explain why they're doing it. So you've got to be able to advocate for yourself, which means you got to have education. Got to have education. Got to invest in yourself so you can invest for yourself. Be willing to do it. That kind of gets me going just talking about it. I got to calm down thinking about that Fidelity thing was just maddening. Okay. And I still think you can go with Fidelity, by the way. You just got to, it's a great platform if you know what you're doing. So, and then a great Twitter point, X. I had a friend of the show say, Robert, just call it X. Don't hem and haw. So I'm working on it. X.com. Mark Meredith mentioned that from August of 2011 to December of 2024, the Vanguard 500 index is annual rate was 14% return, whereas international was only 4.4%. So Meredith says, why would you own anything except U.S. stocks? He then goes further. Inside the U.S. stock market during that same time period, that August of 2011 to December of 2024, guess what? Technology was up about 20% a year. Consumer staples 10, utilities 10, materials 8, energy 4. Can you imagine that? Or it's 4.3. Energy underperformed international from August of 2011 to December of 2024. That's a long time for energy to underperform. So he says, well, why would you just own technology? Why just own, let's just drop that because technology did 19.46%. And then he says, wait a second. Inside the tech sector during that same time period, we had NVIDIA earned 56% a year, IBM at 5%, Juniper at 5%, First Solar at 3%, Intel at 2%. So why don't you just own anything except NVIDIA? Do you see the logic tree Mr. Meredith is beautifully walking us through? At the end, he says, this is satire. Like, don't do this. But this is the logic tree investors can go down. I see it all the time. I see it in my own heart, my own mind. If the U.S. is so good, why don't I just do the U.S. and skip international? And if within the U.S. technology has been so good, why don't I just punt the rest of it? Consumer staples, utilities, materials, energy, blah. And if in the tech sector, NVIDIA was doing so well, why don't I just punt? Why don't I just do everything in NVIDIA? The logic is sound, right? If you're going to drop international totally because of the great performance of the S&P 500, why would you not just keep high grading your returns? And for the astute listener, of course, the learned listener, of which I count a large portion of my audience, you realize, wait a second. If someone had done this exercise in 1999 with Cisco Systems and just gone all in, it was one of the best performers from 96 to 99, and dropped everything else, they would have had a really rough next 20 years. So diversification matters. Of course it does. Risk matters. Of course it does. So it may sound silly when I walk through Mr. Meredith's exercise. Of course I'd never do that. But without knowing it, we can kind of convince ourselves we're being shrewd investors, and all we're doing is performance chasing. That's all we're doing. So I'm one of those crazy people that still says invest in international stocks. Invest, even though the last 13 years, admittedly, have been rough. Stay diversified. And then this is another great chart of data by Peter Mallouk's Creative Planning. I've mentioned his book that I bought previously that's really good. It's called Money Simplified. It's big and it's got a bunch of pictures. It's a great coffee table book, and it gives all these beautiful graphics on how investing works. But he has this wonderful chart on X. He says this: S&P 500 index, again, that's a common index because of the 500 companies in America, representative of the economy, the max intra-year drawdowns versus the end-of-year total. I'll define that. The max intra-year drawdowns, meaning how much top to bottom did the stock go down versus what it actually returned Jan 1 to Jan 1. Does that make sense? So if the stock market dropped 30% in a year, what would the actual annual return be? And listen to these years. This is fascinating. So when I look at this chart, it shows me huge drawdowns in certain years. 1987, I was 2. I remember being glued to my Bloomberg terminal. JK. The drawdown was 33.5%. The total year return was 5.8%. Let me bring something to you that I bet you do remember. Do you remember the COVID drawdown? 2020? I still am amazed at this. Bring the children on this one, maybe even the grandchildren. The drawdown max in that year was 33.9% in 2020. Do you know what the annual return Jan 1 to Jan 1 was? Up 18.4. So the max drawdown is down at 33.9%, but for the annual return, you're up 18.4. Amazing. Now, certainly there are years where there are big old drawdowns and bad total returns. 2008 is one of them. Max drawdown, 08, 48.8%. Total return, negative 37%. So that's a year where, not only did you have a bad drawdown, you had yourself a bad return year. But what I found amazing, there are some runs in this thing where only the brave get the rewards here, the patient get the rewards. From 1982 until, I'm going to call it 99, we had, just listen to this, 82 up 20%, 83 up 22%, 84 up 6%, 85 up 31%, 86 up 18.5%, 87 up 5.8%, 88 up 16.6%, 89 up 31.7%. Your first negative year of negative 3% in 1990. And then I got to breathe in deep for this long run. 91 up 30%, 92 up 7%, 93 up 10%, 94 up 1.3%, 95 up 37%, then 96 up 23%, 97 up 33.4%, 98 up 28.6%, 99 up 21%. That's a run from 1982. And I could really go back to 1978, but 1982 to 1999 was basically an uninterrupted annual return. It was positive. There was 1 year, 1990, where you're down 3%. That's nothing. And now, of course, I stopped before the 2000s, but that has been a remarkable run for one index, the S&P 500. Remarkable. And you have not been rewarded by getting too cute or too smart, thinking, well, had a couple up years, but we're due for a correction. You're going to be really waiting a long time, waiting for your correction, and you're going to regret it. So a Because guess what? We went on another bananas run from 2009 to present. From 2009 to present, we've had one little year, 2018, where you're down 4.4%. This is the S&P 500. That's an incredible run. And then I liked this article. We're probably not taking from the article what the journalist intended, but that's the beauty of the Robert Hunt Financial Market Update. We sneak out the data we like, leave the rest. Mr. Ben Foldy wrote, Wall Street's preeminent short sellers calling it quits. Hindenburg Research founder Nate Anderson, a foe of Carl Icahn and the Adani family, cites job stress as he shuts down his firm. So this guy, Nate Anderson, he's big deal. He's a short seller. That's someone who's betting on stocks to go down. He wiped billions of dollars off the market values of companies, including Nikola and Icahn Enterprises. He's shutting down his firm, Hindenburg Research. Hindenburg. He said, I've spent most of the last 8 years either in a fight or preparing for the next one. He said he accomplished what he set out to do. He looks forward to taking up hobbies, traveling, and spending time with his fiancée and their child, adding that he has earned enough money to provide for them in the future. Now here's where you're going to want to really listen in. Guess how he invests in the future. This is Mr. Research. This is Mr. Short Seller himself. You know what he says? He said he plans to invest his money in index funds and other low-stress investments. What? When I read this article, I was not intending that it would make the podcast, and of course it did. Of course it did. This is an incredible decision. This is a man who has bet his career, life's work has been that accounting data and market data, there is all sorts of inefficiency and inaccuracies that can be profited from. And he's telling you, and he could have said anything here, he's going index funds. Wow. Now, let's say he was a client and he came in and said, hi, I'm one of the preeminent short sellers of the world. I've winding down my firm. How should I invest? I would certainly give him a pass for wanting to continue to short securities or pick stocks because he's one of the best. He's done one of the best. He's saying, nope. Give me that index fund. That's amazing. The article goes on to say all of the home runs he's hit and the misses he's had. But some of the companies he's done well at are Super Micro, Icahn Enterprises, Adani Enterprises, Clover Health, and Nikola. So these are the ones he's shorted, and then he did poorly on Roblox and Block. So a lot of times these short sellers will dig into the data, find out something they don't like, and then go public with it, and it's a big fiasco, lawsuits, all the rest. But they hope their short position profits. But take heart, index fund investor. You are in great company. One of the great eyes for company financials is himself electing to keep his costs low, his investing simple, and his time horizon long, because that's what's going to give him the best shot on his and your investing journey. Until next time.